Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show.
Hey everybody, welcome into another edition of Phil's Tax Hacks and Other Retirement Facts, episode number 102. And we're going to talk about minding the gap. And Minding the gap. What is that? We're going to, not mining it, minding it.
Minding, yes. Pay attention to that gap.
That's right. We're going to get into that in just a second here. And I got the idea, Phil, actually, we were talking on our last podcast. You kept saying we got to watch out for a gap. You said it a couple of times, actually. Yep. So I thought, well, hey, let's see what the gap is and dive into that a little bit. You know, have you ever been to London?
Nope, never been.
Okay. So they call it the tube, the subway, right?
Okay, yep.
Call it the tube. And they have little signs in different places when you're transitioning from the platform. And they may, I don't know, it's been a long time since I've been in New York or been on one here in the States. But when you transition from the platform to the car, to the subway car, it says mind the gap, right?
Yep.
So that you don't trip, fall, step into the thing, whatever, right? Because that would be bad, you know? So that's kind of the idea here. Let's mind some financial gaps so that we don't step into it and get ourselves into some trouble. So I've got four here I want to go through just to kind of have you break them down for us a little bit. And let's start with the first one, which is really the biggest one. I think this is the one pretty much everyone thinks about. They may not even think about these other ones, but it's the paycheck gap.
Yep.
I've gotten to retirement date. I've left work. I got no paycheck no more. Right?
How does all this work?
Yeah, all this work.
Yeah, it's funny. It's one of the first questions that comes up after we've done planning with a client. We've got all the things figured out, and their plan works great. They've got more than enough to live on, and we got the plan for Social Security and pension and Roth conversions, whatever, all the pieces in their plan. And as we're starting to look at investments and this is how it fits together, they're like, okay, so how does this work? How do I get this money that I'm going to need, And you're used to getting a paycheck direct deposited in your bank once a month, every other week, whatever that schedule's been for you. So we've kind of built our spending pattern around this. And how does that work?
We still need it.
Absolutely. For us, our clients, the way we do it is typically we set it up on a monthly basis, whatever that day of the month is that you want to get paid. We'll have that direct deposit go into your account from whatever investment that is in our soon bucket that's funding that income need. So, but yeah, it's an important point, more for just peace of mind, but also what is it? How is it built into your plan? If you haven't thought about that, you can't just look at the big number and say, oh, yeah, I've got enough. And okay, well, how do you make that work? Where is it coming from?
You got to turn it in to the mailbox money, that we used to think about ETF or whatever now, where it's just, coming right, or EFT. I got it backwards.
Yep.
What's coming in. Yeah. So our EFT is coming into our account, probably from some ETFs, right?
Yeah, that's right. It could be selling ETFs to,
So that's the first gap we've got to mind, is that paycheck gap. Getting comfortable with that transition of no longer receiving that weekly paycheck or biweekly or monthly or however you got paid, and now taking from our actual assets and investments and the things that we've spent all our time accumulating. So that's the first one I had, Phil. Now, the concept of retiring earlier has certainly shifted. We talk about it many times on the show. And so let's kind of look at it from this standpoint. If you're pulling the trigger early, okay? So let's say 55, 57, 59, 60, 61, whatever. If you pull the trigger and retire, then you have got to mind the Social Security gap. And then you also got to mind the Medicare gap. Now, that's going to shift a little bit, but obviously you can't start pulling those until a certain age.
Right. Yeah. So, the earlier you retire, it opens up more, I don't want to call it challenges, but things we have to look at, right? So Social Security is one of those. If you're retiring prior to 62, it's not even an option. So all of whatever you need till that point is coming either from your investments, or maybe you've got a pension that would be, you're eligible for. Maybe that gives you a portion of it. But even if you retire, even let's say at 62, is 62 the right age for Social Security? What's your strategy around Social Security? Probably is going to make sense for most people to delay it to some extent, kind of, depending on health and a lot of other factors. So there could still, even if you retire in that 62 range, be a gap that you have to bridge to get to whatever the age is of Social Security. And that's still not going to provide all the income, but at that point provides a little bit more. On average, it's maybe around 40%. It's kind of where I see big picture. Most people could be more or less depending on what your spending is, what your total combined Social Securities are. Yeah.
That's the average. Okay. Yep. And then of course the Medicare gap is the big one.
Yes. And that's even a bigger one because health insurance, in the world we live in today is extremely costly.
Yeah. It costs some money.
If you're retiring significantly earlier than 65, you mentioned even like mid 50s, late 50s.
It's been happening more.
5 to 10 years of paying medical premiums out of your own pocket. That's a big number. You absolutely have to understand that and have built that into your plan.
And do you find that is that a big deterrent? Like I would think that could be, even if you're pretty good, ready to, from a financial standpoint, the plan looks like it's going to hold together. You could retire early and sustain it for a long, longevity. Is the medical thing the one that maybe throws the final wrench in and says, you know what, we shouldn't do it?
Yeah. I have a lot of clients that, we've run the math, and most clients are in their 60s, early 60s, where they're thinking of it. And then we get to that medical discussion and sometimes even though financially, hey, you can do it, when you start to look at, well, here's the reality of medical, right? So probably is going to make sense to go on COBRA, which, thinking back in the day, it's like, oh, COBRA, are you kidding me? That's it's outrageous. Well, if you shop it today, actually, it's probably a pretty good deal.
It's surprising too. It's become it's become the annuity of the medical, like the annuity term of the medical side. For a lot of people, you say annuity and it's a trigger word. They go, I don't want an annuity. I don't want to talk about it. I hear they're all bad. Sometimes you say COBRA and people go, oh man, it's crazy expensive. Well, yeah, it was. It
was. But today it's probably similar costs in what you're going to pay going out and getting coverage on the marketplace.
Yeah.
But it's going to be better coverage, so it's not to say it doesn't work. I'm just saying go into it fully understanding, and that's where your advisor really should help play that role, is showing you the options. And if they don't have somebody in-house that can help with that decision and show options for medical, make sure that you've got somebody that can show you that, because that's a big gap that you have to fill.
Well, and I think the point that you made is that if your advisor's not addressing those potential gaps on you, then you've got an issue there, because it can seriously, it could hold you up, really. Like you could be ready to roll and maybe retire a bit earlier than you thought, but that medical thing could be the thing that the linchpin that kind of stops it. So,
for a married couple, if you're going to the marketplace and this isn't great coverage, you can spend easily $1,500 to $1,800 a month for coverage, and you still have a $5,000 to $7,000 deductible or more.
That's hefty. So,
you're talking $18,000 to $20,000 a year premium cost. You've got to understand that, because that's a
lot to pull out of your that's a lot to pull out of your retirement accounts. So that could impact your longevity of your retirement accounts. So something,
and that's after tax money. So
okay. Well, so let's talk about the next one here then, which is inflation, on when we're trying to mine these gaps. The inflation gap. Man, this joker right now is it's saying, hey, and that gap has gotten a bit wider.
Yep. Yeah, it's kind of, remember me? I think most of us have forgotten what inflation was really like, right? The last
years,
10 years, we've been in this low deflationary environment in some points. Over the last 10-year time frame, there's been 3 years where Social Security didn't even give a cost of living adjustment.
And there's a pretty big one that's coming up there.
We were deflationary, and they're talking the next one for 2022 is in the 6% range.
Which
you think back, it's like, that's huge. Yeah.
The last time we saw something like that. And to me, if that wasn't an indicator that we've got inflation going on, even more than they're honestly admitting on camera or in interviews, that was like that kind of sign of, hey, y'all, this is a bigger deal than they try to play it down to,
Yeah. So, inflation, and I've told clients this, and we've planned for this all along. It to me is probably one of the bigger concerns you have to understand and plan for in your retirement, because everything moves in cycles, right? Markets move in cycles, interest rates move in cycles, inflation does the same thing. Right. So if you follow what's taken place in that cycle, we've ridden this wave of interest rates and inflation's down, kind of bouncing around the bottom for a while, at some point it's going to tick back up. That's just what happens. I mean, if you look at history, that's what goes on, right? We go through these cycles of inflation, deflation, I mean, it's back and forth just like markets do. Yep. So nothing you should be surprised by. Make sure you're understanding it. It's built into the plan. And then what's your plan to help hedge against that?
Yeah, exactly. So you got to have a plan to deal with these gaps. And that's the next one. That was that inflation gap. Yep. The long-term care gap, kind of touched on that a little bit with the Medicare in some conversations, but Medicare doesn't cover long-term care. So it often winds up being a place where people kind of disassociate that.
Yep. Yeah. And there's all sorts of misunderstandings around, what is quote unquote long-term care. Does Medicare cover it? Well, there's some benefits under Medicare that might look like long-term care, but they're very limited and very specific qualifications to even qualify for them.
Right.
But yeah, again, when we're planning for clients, how we approach it is, number one, let's make sure the plan works. If everything works fine and you pass away in your sleep, let's say, it's that normal, what everyone would want, but then you have to stress test it and understand, well, what happens if that's not your reality? And unfortunately, for more and more individuals, their reality is going to include some form of long-term care.
Getting that gap covered, because that oftentimes, more times than not, really is what ends up happening. It completely wipes out a couple, and the second person is really left in bad shape, and they've lost their spouse to boot.
Yes. Yeah. I mean, it's something that you have to understand, run the math, we've talked about that a lot of times, but you've got to understand the math and cost of long-term care and how are you going to pay for it if it happens. Don't wait till, I'm too young for that. I'm going to look at it later. And because as life insurance goes or anything else, I mean, when you need it, it's too late. You can't get it. When the house is on fire, you can't call your insurance agent and say, hey, that policy you were talking to me about? I think I need it.
Well, and what is the average, Phil? Do you happen to have any, just off the top of your head, for long-term care stays? It's what, 2 to 3 years on average?
I mean, it's 2 to 3 years. It kind of depends on, what you consider quote unquote long-term care. Mm-hmm. I mean, it generally moves in stages. The traditional long-term care, you're confined to a nursing home. I mean, generally that's a shorter period, maybe even 18 months or less for most people. But I mean, leading up to that, there's some kind of assisted living or maybe home care early on. And that brings up a whole nother set of questions is, well, if you had your choice, how would that look? Would you rather have care at home first, or, I'm going to spend everything down and let the state take care of me on Medicaid, which that's a plan, but not necessarily a good plan.
I think most people want to go with the home thing, obviously. And so, the type of illness can determine the length. And then of course it can determine the care, the need. And it gets pretty hefty. So you got
it does.
Yeah. You got to mind that you got.
If you look at the average cost of nursing home care today, and this is a semi-private room, so it's not even your own room, it's in excess of $95,000 a year.
Many times on the show, we have to go to this area because it's we're humans, we're all going to pass away. Yep. And B, it is the nature of what you do. You're going to inevitably be in a situation where there's somebody left behind. So we're calling it the widow gap. Now it could be a widower's gap as well, but we're calling it the widow gap. And there's a couple of key components there that are going to create this gap you've got to be mindful of, and hit them up for me.
Absolutely. So, I mean, it's something that if you haven't looked at with your advisor, you have to understand what that looks like. It's, Mark, to your point, it's not a comfortable discussion, but it's reality. I mean, the bottom line is there's going to generally be a surviving spouse for some period of time, 3, 5, 10 years, especially if there's an age difference in spouses. I mean, it could be more.
Right.
And several things happen. I mean, we know for a fact, one of them is the lowest Social Security benefit's gone. So plan for that. You're going to lose income.
That's a gap. Yeah.
There's a gap. The other thing that could happen if you have a pension, there could be some kind of a loss depending on survivorship options. So if you took a 50% survivor option, okay, well, so my spouse now is going to lose, one of the benefits, the lowest of the two, but, so call it a third of the income maybe there, maybe lose 50% of the pension. So that's a pretty significant drop of income so far.
Big time.
How are you going to supplement that? In most surviving spouses really don't have that much of a decrease of income need. It's going to be some, obviously. I mean, there were 2 cars, the one spouse had hobbies, things like that.
Right.
But housing is housing. I mean, that whether it's 1 or 2 people is pretty consistent, The reality is they might go out to eat more than what they did before because it's just them, travel might, there's a lot of things that,
cooking for one just kind of gets weird and
And then the last one that is often overlooked is taxes, understanding what that looks like, because when you were married, the tax rates were married filing joint.
Mm-hmm.
And those brackets are, in today's environment, twice what they are as a single. So just some simple numbers to put it in perspective. Today, that married couple, they pay 10% tax on about the first $20,000. From 20 to about 80,000 is where they pay 12% tax. A single surviving spouse, you become single now, cut those numbers in half. So the 10% bracket's only 10,000. You're going to get to the top of that 12% bracket today, not at 80,000, but at 40,000.
Oh, wow. Yeah.
So very often a surviving spouse with less income is going to get forced into the higher brackets. So you have to plan for that. And that's where having money in that tax-free bucket, the Roth bucket, so to speak, comes into play heavily for a surviving spouse, because now they get to control their taxes by managing where the money's coming from and pulling from that bucket.
And that's pretty massive. I mean, that's a heck of a gear change.
It's huge. Yeah.
To deal with. And if unfortunately, things happen, and if that happens sooner than you expected, and often it does, comes out of the blue, right?
Yeah.
There's many times where we see it coming, and there's situations we know that's going to be the case, but often it comes out of the blue. And so if you didn't take care of these things ahead of time, it's kind of like the flood insurance. There's, you're not much you can do about it. You're going to have to now ride that wave, unfortunately.
Well, and that's back to the stress testing. This is one of the other stress tests that we run is, okay, everything works great if you live to whatever your full life expectancies are. But what happens if one of you passes away and we look at for both spouses tomorrow?
Yeah.
And then in 5 years, and then in 10 years, and 15, just to help lay out the facts of, hey, if it happens, this is what it looks like. Because the concept of, oh, I'm retired, I don't need life insurance anymore, generally is the case. But oftentimes, if something happens early, there could be a gap. Maybe for the first 5 or 10 years, if something happens, there could be a gap. Understand that and plan for it.
Your job is to shine the light on the gaps. If I bring it back to my initial thing of the tripping on the subway there, your job is to shine the light and say, hey, let's mind this thing and let's do something about it. If you choose not to do something about it, that's on you, and you still go ahead and trip. Well, that's because you didn't listen to that advice, right? Right.
Yeah. So at the end of the day, all these points need to be covered in your plan. So if you don't have a plan that's looking at every one of these,
you got a gap.
Start looking at it. You've got a gap, right? Yeah. Just understand you're probably missing something somewhere that you need to revisit them.
We try to shine light on them on a regular basis here on the show. And of course, as always, if you need some help, make sure you're checking with your advisor. If they're not talking with you about these, bring them up to them, right?
Yeah, absolutely.
To bring them up to them and say, hey, listen, what about this, or this? And if you're still not getting that kind of conversation that you need to have or want to have, that's okay to go get a second opinion. You could reach out to Phil, of course, if you'd like to, at philstaxhacks.com. That's philstaxhacks.com. There's ways for you to contact him, get in touch with him. If you're watching this on YouTube, the number's on the screen. So lots of ways for you to reach out and have some conversations for yourself. Phil, my friend, thanks for hanging out with me as always and having these conversations. I appreciate it.
Not a problem. Enjoy it. It's a great time.
Yeah, we'll see you next time. We'll have some more conversations coming up a little later on here in September, but enjoy yourselves. Have a great, safe week, folks. And we'll see you next time on Phil's Tax Hacks and other retirement facts with Phil Putney.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.